And we're back on set. Geoff Gannon, Andrew Kuhn. Hope everyone is having a great day. Let's talk about growth.
Okay.
And Philip Fisher. Mm-hmm. How do you judge growth in a company? And how would you value a company that is growing exponentially? And the reason this is on my mind, and we were talking a little bit about this yesterday, is because Zoom Technologies is at $110 billion market cap now, which, by the way, in 2017, they were valued at a $1 billion market cap. They reported earnings the other day, and their revenue is up to $600 million, and it's just grown like crazy. So I'm kind of curious because the stock's been getting bid up a lot. It's like, how do you value a company like that? How do you value growth?
Well, we talked about that. It sounds reasonable to me, Zoom. Like, I mean, not that I would buy it, but it sounds reasonable. There's nothing about the description of the market cap and everything based on what you said. People pay for the service and the addressable market of how many people that it would be reasonable. So, yeah.
Is that a type of company that, like, Philip Fisher would be interested in as a growth stock?
No.
What type of growth stock would he be interested in?
Well, I don't know enough about it to know, but he cares about the organization. So the fact that something, like as an example, like Google bought YouTube, right?
Yeah.
So YouTube was attractive and whatever, but it had a lousy organization. So Phil Fisher wouldn't have invested in people like the people who are running YouTube. So maybe the people who are running Zoom are great, but he cares about the organization and their long-term approach to things that way, not about a product. He's not a venture capitalist.
So how would you value a business like that, though? Same way you'd value every other company, or
what's the addressable market? You know, that's how you value it, and then how long till it could reach that. And then you discount it back. With Zoom, from what I know of it, it seems easy to value in the sense that you'd say, okay, well, is it going to dominate in what it's doing? What's it going to charge? How many people are going to use it? And when's all that going to happen by? And that's just a DCF. So that seems fairly easy, the same way that it should have been easy to value America Online or something. The problem, of course, is that there could be competition and then they end up with none of the market, or they end up with lots of people having free products. You know, because it's unclear, like, why wouldn't there be lots of competitors who would just do the same service for free and stuff, you know?
Now, what about like a company like Celsius, for example, that's growing their top line, everything is just growing, but it's in a very competitive industry. So it's like, how would you go about that?
I don't think the industry's that competitive.
You don't think energy drinks is, like, healthy energy drinks are competitive?
Not really. I mean, it's a competitive space of it for beverage stuff. I would agree with that. There's a lot of things that aren't mature there. The competition's mostly for the shelf space, but it's not very competitive compared to lots of industries that we look at. No. I mean, they're not going to have a price war in it. So, but there's going to be competition for shelf space and stuff. Again, I think that one's fairly easy to value if it's like, is it a reasonable valuation or not? We did one looking at Monster and stuff like that. The ones that are hard to value, like Tesla, is the kind of thing that's hard to value because they're become bigger problems. What will the gross margins be? I don't know. Using the example of Celsius's gross margins and things like that are very consistent with other energy drink companies. Tesla's margins are not consistent with other companies like that. And so the problem that I see that way is like a guy who worked at Porsche a long time ago had a saying that he said two Porsches on a street is a tragedy, meaning that their pricing power was based on the ability not to have exclusivity. And so the question becomes like, okay, if you greatly increase the number of Teslas you sell, does that change your pricing ability and things like that? It certainly changes your cost. It makes it cheaper to make each car, but can you demand as much for the car? Celsius is not an exclusivity thing. So if they have 100 times more people drinking it, you don't need to charge less for it. So it's a little bit easier to do the math on that. It's very hard a luxury good type product. And I don't know that Tesla is considered a luxury good, but luxury goods have that problem. They're much harder to figure out the valuation on them because the gross margins could be lower. It could be higher when the company's smaller, and then if they go very mainstream, then it becomes harder to have pricing power.
Cool. Well, I want to thank everybody for being a subscriber. If you're watching us on YouTube, hit that subscribe button. Follow the app. Lots of videos just like this. If you are a subscriber and you want to ask a question, feel free to email me, focuscompounding@gmail.com. We appreciate all of the support. We appreciate being a subscriber, and we will see you in the next video.